Good evening, everyone. Time for another silver update. This is the 1-minute chart of gold provided by netdania.com. You can click on the link below. Now, we had a big flash crash in gold today, which occurred exactly at 10:15, actually 10:13 a.m. and gold was actually halted. We'll see that when we look at the Zero Hedge article. You can't see close enough here, it's not granular enough, so we'll have to look at the second by second trading that was on Zero Hedge. Now, when you're investigating something like this, the first thing you want to do is look at other markets to see if the same thing occurred. So we want to look at silver, and that's the first thing I looked for. And silver had a similar sort of reaction, not really as large of a move and not down into new lows, but still accompanied by very large volume. You can see both gold and silver at the time were in the process of breaking out into new highs on a decent amount of volume. You can see that here with the volume coming in around 745, increasing all the way up to that flash crash that we had. So, and the other thing that I noticed, the only other thing that really stood out was activity that occurred in the Japanese yen at roughly the same time. You can see that this pretty much marked the top of the dollar-yen cross. In other words, the yen rapidly gained value after this point. So was this related to the Japanese? I don't know. So let's go over to the Zero Hedge article where we can look at some more details of the flash crash that occurred. Now you can see on this first chart here, you get an idea. This is from Nanex. You can see the halt. It was actually halted this period here where there's no volume, and you can see it was halted at about 12:10 or so for the low. Maybe 12:15 was the halt, and then it went sideways, no trading at all, and it opened back up about 12:17 and then rapidly started to recover. Here's another view of that same thing. You can see the little section here with no volume. And here's another one. This is probably the best one, where you can see the stair-stepping down effect. Now, one of the explanations that was given was that this flash crash was the result of a fat finger. And that's one of the explanations. If you remember the original stock market flash crash back in 2010, they blamed it on some brokerage, and then there's others that are blamed on fat fingers. This is obviously not a fat finger, because you can see that there's a large number of trades all the way down. So this isn't one gigantic trade, or it would have just jumped all the way down here. It was a series of trades, and I'm going to show you that was probably a bucket shop drive or a stop loss picking off situation. And I'm going to try to explain to you the reason for that, why they operate that way. So I'm going to start off with Silverfinger. This is a classic. It came out in 1980, Playboy magazine. And why Playboy magazine? Well, at the time, that's sort of the equivalent of today's internet, where they could report some real news as opposed to the controlled media. Yes, all the media was controlled back in 1980 as well as it is today. So this is probably the best article. You can go get this PDF. I'll put the link on there. This is probably the best article about the Hunt brothers' attempt to corner the silver market. And you know the story, that pretty much what happened was that the government decided to shut down the Hunts by using the CFTC regulations. So I'm going to begin reading here. On top of all that, Bunker really did believe in silver as a long-term investment, the underpinnings of a new economy. He did not say that in so many words to the CFTC men and the exchange officials, but he did give them a glimpse of his basic apocalyptic vision when he revealed a previously undisclosed feature of his silver play, the fact that he was moving his metal to Europe. This time he did not fly the bullion overseas in chartered jets with cowboy guards. As he told the CFTC, Bunker simply traded 9 million ounces worth of metal he held in Chicago and New York exchange warehouses for an equal amount of bullion held by other traders in London and Zurich. The reason, as he explained to the CFTC and the exchange officials, he feared that the U.S. government might expropriate silver from Americans just as it had expropriated gold back in the 30s. But Bunker's assurances that he was willing to cooperate as much as possible apparently mollified the CFTC officials. The CBOT, that's the Chicago Board of Trade, however, concluded that it was time to act. In a move aimed directly at the Hunts and other big buyers, the Board of Trade raised the margin requirement and declared that silver traders would be limited to 3 million ounces of futures contracts. Traders with more than that would have to divest themselves of their excess futures holdings by February 1980. And then it goes on into the details. So basically what happened was the government moved the regulators to change the rules as far as how many ounces of silver could be bought and what the margin requirements on that would be. So essentially, in the end, the government pretty much banned the buying of silver and only allowed the selling of silver, and that pretty much is what bankrupted the Hunts. Now, I personally don't believe the Hunts would have been successful at that time. If the Hunts would have been operating at this time, they probably, if they would have stuck to physical silver only or primarily, they probably could have succeeded. In that day, I think the U.S. government still had about 5 to 10 billion ounces of silver stockpiled, so they probably couldn't have succeeded anyway. But nevertheless, the government came and changed the rules on them. Now, why is that important? Well, first of all, it's important because what we're talking about is margin here. So when people buy gold contracts, let's say that they have a long position that they've put in at 1235 or 1240, they're long the gold contract in the paper market. They usually put up roughly 5 to 10% of that investment. They're trading on margin. So to protect that position, because you have to remember, if the market moves rapidly against them, they will get a margin call, which means they have to put up more money. Now, they could initially put up the entire amount of money it takes to take delivery of that amount of gold. After all, they know that they're buying 100 ounces at $1,240. So that's an exact amount of money. They could simply deposit all that money in their futures account and be guaranteed of being able to take delivery of that gold when the settlement date occurs, barring some unforeseen circumstance. And that unforeseen circumstance could be the government changing the rules on delivery, or an MF Global type event where the brokerage evaporates and all their money is gone. So there's no easy position for someone who wants to speculate in the futures market long gold. So they put in stops to protect their margin so they don't get a margin call. And even if they do get a margin call, if you look at the agreement that you sign when you sign up for your futures account, your position, if your margin call is not met within a certain amount of time, they will liquidate your position. So effectively that acts as a stop. Now, what that means is that under the market there are these buy stops. So our imaginary trader here who's long a contract of gold at 1240 may put a stop down here at 1235 or 1230. What that does is effectively limit his losses to around the amount of money that he put up for margin, so that he's not going to lose more than that. That is a tremendous incentive for corrupt players and, of course, the government to have what I will call here bucket shop drives. And we'll see in Jesse Livermore exactly what that is. But essentially, it's a drive to run the stops, to pick off all the protective stops. These are buy stops, so they're selling into these buy orders all the way down, picking off every stop that is below the market. Now, if we pull out the gold chart to, let's say, the 1 hour here, we can see that this bucket shop drive that they did took gold back down to nearly the breakout point of this move. We had another type of flash crash or bucket shop drive here that went down to 1181 before the market took off. Now that's very common to see as well. In other words, they took out everybody that was long and then they went long. So you can see that this drive pretty much took out everybody who had gotten in long above that 1200 point and had protective stops. Now let's jump over to Livermore so we can understand that. Of course, this is the classic reminiscences of a stock operator. I'll go ahead and post the link for the PDF. And as you know, or as you should know, there's really nothing new under the sun. There's nothing new on Wall Street. There's nothing new in the markets. The criminals have always operated in the same way. Unfortunately, in the past, the criminals were the bucket shops and small-time crooked operators. Today, the criminals are big-time banks and governments. So that's what we're battling against. But let's read the explanation here that Livermore makes. Now, he was 15 years old trading in the bucket shops. Anyhow, at 15, I was making a good living out of the stock market. I began in the smaller bucket shops where the man who traded in 20 shares at a clip was suspected of being John W. Gates in disguise, or J.P. Morgan traveling incognito. Bucket shops in those days seldom lay down on their customers. In other words, just shut down and refused to pay. They didn't have to. There were other ways of parting customers from their money. Even when they guessed right, the business was tremendously profitable. When it was conducted legitimately, I mean straight as far as the bucket shop went, the fluctuations took care of the shoestrings. It doesn't take much of a reaction to wipe out a margin of only 3/4 of a point. Also, no Welsher could ever get back in the game, wouldn't have any trade. So that's the essence of a bucket shop. A legitimate bucket shop, if there could be such a thing, was where you put down a certain amount of money, in other words, margin, and once the move in the market takes out that amount of margin, your trade is automatically closed out. So generally the bucket shops made money simply by people trading incorrectly and having the market move against them, and they would be taken out. But they also had what were called bucket shop drives. And bucket shop drives would occur when the bucket shop was long or short too much of a particular security. Now, if you remember, they were bucketing trades, and what that means is they weren't really placing the trades on the stock exchange. They were just simply taking the money and not placing any bets. But sometimes when they found themselves too far in one direction, they would take one of their men down on the street and actually have them buy or sell that stock to drive the price below the vast majority of stops to take out the traders. And that's what he's talking about when he refers to a bucket shop drive. He says here, they also used to form discretionary pools in the office, and as a great favor allowed their customers to authorize them in writing to trade with the customer's money and in the customer's name, and they in their judgment, as they in their judgment deemed best. That way, the most cantankerous customer had no legal redress when his money disappeared. They'd bull a stock on paper and put the customers in, and then they'd execute one of the old-fashioned bucket shop drives and wipe out hundreds of shoestring margins. They did not spare anyone, women, school teachers, or old men, being their best bet. And the same is true, of course, today. And he refers to the same thing here. When I first came to New York, there was a great fuss made about wash sales and matched orders. for all that such practices were forbidden by the stock exchange. At times the washing was too crude to deceive anyone. The brokers had no hesitation in saying that the laundry was active whenever anybody tried to wash up some stock or other. And as I have said before, more than once, they had what were frankly referred to as bucket shop drives. When a stock was offered down 2 or 3 points in a jiffy just to establish a decline on the tape and wipe up the myriad of shoestring traders who were long the stock in the bucket shops. So there you have it. That's what we saw in gold today. In essence, it was a bucket shop drive in the paper market that cleared out all of the stops who were the short-term long traders who had taken a speculative position in gold, thinking that gold had bottomed. That's not going to be tolerated by these corrupt banks and the Fed and others who are involved in manipulating these markets. If you're going to trade gold, you're going to have to put up the entire amount of margin and take the risk that by waiting to the delivery date, that 1, the government isn't going to change the rules. 2, there won't be some type of MF global collapse in the meantime. And 3, they're actually going to have the gold that you bought, and you'll be able to take delivery on the settlement date. So you can see there's no easy answer. Basically, what happened to the Hunts through regulation is now happening in the gold market through market manipulation. The methods are different, but the effect is the same. Nobody who wants to take a speculative position long the metals is allowed to trade unless they're willing to take the risk of losing 100% of their investment. So that pretty much clears everybody out of the paper markets, and that's exactly what they're intending to do when they do this. Now, I had a reader who wanted to have me do some silver picks, and his question was, what is a good coin that you can buy that will maintain its value in potential smackdowns or will have value preserved going forward? So I just decided to walk you through what I normally do when I'm looking for something to pick up that is a semi-numismatic coin and has those features. So normally I'll go to APMEX, and the reason why is they have the most supply of the coins that I like to look at. And I will go and look at silver. There's a number of things that I'm looking for when I'm doing this. I'm looking for semi-numismatic silver, and I'm looking for a coin that I deem as collectible. So I'm looking for a coin that is unique and a coin that will be desired by investors in the future. And I'm also looking for a coin preferably that will have low mintage. And the last thing is I'm looking for a coin that is potentially one that is going to go out of circulation in the sense that you won't be able to buy it. So normally that's going to be an older coin. The older the coin, the better. So the first thing I will do is organize these by low to high price. So we're looking now in the Wildlife series, and you can see the first one that comes up is the 2013 pronghorn antelope, and you can see it's around 25.23, about $4.99 above spot. Not that great of a deal, but halfway decent. As far as the date, last year, so not really one that is going to necessarily roll off. Of course, we want to check the number. There's only 337 left. And then the coin itself, I would say so-so. It's an okay coin, not something that I would think that would be big with collectors. So that one's probably going to be a thumbs down. The next one is 2013 Wood Bison. I like the coin a little bit better. So I think there's more collectability, and of course that's always just going to be personal opinion. The number of coins that are there's about 682. Again, it's 2013, so it has that negative. And this is $5.99, so that's pretty steep above spot. The next one here is the Canadian Silver Grizzly, but this one is abrasions and spotted, so not going to want that. We have the 2012 Moose, so that's a little bit better because it's another year older. There's going to be a point here fairly soon that these won't be available. The coin itself, I would rate that below the Wood Bison, a little bit above the Antelope. Not really big on that coin. The number that's there, looks like there's 1,000 of them there, and it's $8.49 above spot, so that's pretty steep. And then the last one here is one that I've covered before, is the 2011 Grizzly. That, for me, is tops. It's only behind the Wolf as far as the coin itself. Love the coin. Fantastic coin. Now, it's going to be about $9 above spot. That's pretty spendy. And there's only 246 left. There's really not much beyond that. There's the Cougar, which is very high price. So I definitely would be going with the 2011 Grizzly, even though that's that much higher above spot. It's a highly favored series. It's a very good looking coin. I like the coin, and it's 2011. It's going to roll off, and it's just simply not going to be available. When it does come back on, it's going to be something like the 2011 Wildlife Wolf series, and you can see that's about $50. So probably when the Grizzly comes back on, after it rolls off, it's going to be about $50. That's going to be my top pick for the Wildlife series. So that's the basis of how I make that decision. Let's go down and look at my other favorite that I like to look at, and that's the Lunar Series 2 on the Perth Mint. I think I passed it. And that's currently the newest one is the Horse. So we're going to do the same thing here. We'll just go ahead and list them from low to high. First coin we have coming in is the 2014 half ounce at $13.91. It's going to come in around $28. That's going to be almost $8 above spot. That's pretty spendy. There's 500 of them. As far as the coin goes, I love the coin. Fantastic coin. That's top notch as far as desirability and collectability. There's also the Chinese factor there. There's so much going for that coin. But unfortunately, it's 2014. So it's not going to roll off anytime soon, and you're paying a decent premium above spot. Next coin is the 2013 half ounce Year of the Snake. That one's already in the process of rolling off. I bought a few of those back at $13. That's just too pricey. The 2012 half ounce Dragon, same deal with that. The next 1 ounce is Abrasions. We've got the half ounce Rabbit, and there's the Year of the Horse at $38. So you can see with the Lunar series, we really don't have a lot that are going to meet the criterion. Maybe if you wanted to make a bet on the Year of the Dragon. Now this one was very unique because for the longest time, both APMEX, Gainesville, and I believe Provident, almost everyone that pre-ordered this, you have to remember with Perth, they only mint what's ordered. Almost everyone that pre-ordered this coin was asking $99 for this coin. That was for the longest time. So what happened was they kind of priced themselves out of the market, and it just became so ridiculously high that people just ignored the coin. So that's a possible play. Even though it's fairly expensive, it's definitely down from where it started at $99. You can pick them up for $44.99. But again, that's a big gamble. That's more than $20 above spot. And then the next one here, this is probably going to be the best bet because it's the horse, which is just an incredible coin. I can't say enough about that coin. Fantastic. And it's the 2 ounce, so it doesn't have the premium that's built into the 1 ounce and the ½ ounce. And you can see that there's about 290 of those, and the premium above spot with 52.98 an ounce is going to be at about $26.50, so that's about $6.50 over spot per ounce. So that's not bad. That's probably going to be my pick on the Lunar Series, but there really aren't that many picks. You can see that it's 2014, so it doesn't meet that criterion of rolling off. There just simply isn't anything available in the Lunar Series. In the Koala Series, you've got the 2000 10th ounce, that's way overpriced. ½ ounce 2013, 1341, that's a pretty good deal. That's $3.29 per coin over spot, about $6 over spot. That one, they only have 7 left. The coin itself, well, it's okay. It's kind of a, I don't know, a spiky looking koala. Not my favorite coin, and the price though is pretty good, and it's going to be rolling off soon. So that one might be a reasonable play. 2014 ½ ounce, I don't even like the coin at all. That's personal preference. Here's the 2012 ½ ounce. That one's at $15. They have 255 of those, and that's an okay coin. That was when they were getting into that spiky design that I don't particularly like. So that one's so-so. Now, this one may be a good play. Here is the 1 ounce 2013, and that's going to roll off fairly soon. You can see you can get them for $24. That's pretty cheap. That's close enough to spot that you're talking about no appreciable difference between that and an eagle, but you're going to have this numismatic play built in there. So that's probably going to be my favorite for the Koala Series, is that 2013 1 ounce. Don't really see any others on here. So let's wrap up and take a look at the Kookaburra Series from Perth. That's going to be the top 3 from Perth. Those are the 3 I always check, is the Kookaburra Series, the Koala Series, and the Lunar Series. On the Kookaburras, we have the 2014 for $3.99 above spot. Now, you have to remember, if you really like the coin, and that's a pretty good coin, and you think that we're near a bottom, there's no reason that you can't pick up these coins. 24, 23, that's close enough to spot that the premium is not going to be that much different than a maple or an eagle, but it's got quite a bit of potential numismatic value. There's about 500 of them there. So that's a thumbs up on that coin. Doesn't have that roll-off time premium built into it. 2013, that's going to get a little closer to rolling off and not being available. The coin, I will say, is okay in my opinion. I don't like it as much as the 2014, and they have about 395. There's the 2013 Snake Privy, and that's pretty much it for the Kookaburras. So nothing really jumps out at me on the Kookaburra Series. There really wasn't anything that jumped out at me as far as being an absolute screaming buy with all those criteria. So those are the criteria that I'm looking for. I'm looking for a coin that is highly desirable collectively. Looking for a coin ideally that doesn't have a lot of mintage. One that is soon to be rolling off and not be available and come back repriced at a higher price. And one that is fairly close to spot, that is not does not have an appreciable difference between the price you're paying for it and your standard eagle or maple. So back to the gold situation. We had a flash crash today. That's very important. That's a bucket shop run. by the one bank, as Jeff Nielsen calls them, the crooks and criminals that run the governments of the world and the banks of the world and the economies of the world. They're interested in suppressing the price of precious metals, running out anybody who is trying to profit from a bottom in physical gold. We're going to see a lot of this going forward. Remember, as Bixwehr has warned, they can put the price of the paper anywhere. The only way to battle them is to stack physical. And we'll talk to you next time.